Hello, I am Jim Schaefer, a California family law forensic accountant, and I am pleased to co-present this presentation on issues related to marriage of Moore and marriage of Marsden. Kathryn Kirkland is joining me. She is a retired certified family law specialist with 40 years experience and an author for family law publications.
Jim and I have had notes of appreciation on the Moore-Marsden calculation for the number of videos that we have created. This video is a deep dive refresher for marriage of Moore, decided by the California Supreme Court in October 1980, and marriage of Marsden, decided in 1982. In this video, I have asked Jim to explain the numbers and related computations from the decision.
As we listen to the facts described in the decision, I will illustrate in a chart.
Liddy purchased the house at 121 Mira Way in Menlo Park in April 1966, about 8 months before the parties' marriage. The purchase price was $56,640.57. Liddy made a down payment of $16,640.57 and secured a loan for the balance of the purchase price. She took title in her name alone as Liddy S. Doak, a single woman. Prior to the marriage, she made 7 monthly payments and reduced the principal loan balance by $245.18. The parties lived in the house during their marriage and until their separation in June 1977. They made payment during this time with community funds and reduced the loan principal by $5,986.20. Liddy remained in the house and continued to make payments, reducing the principal by an additional $581.07 up to the time of trial. At that time, the total principal paid on the purchase price was $23,453.02. The balance owing was $33,187.55. The market value of the house was $160,000, and the equity therein $126,812.45.
We proceed with the resolution with the apportionment to wife's separate property and the community interests. The decision in marriage of Marsden by the Court of Appeal clarified that the separate property was entitled to the premarital appreciation in addition to the credit for the paydown of principal.
Where community funds are used to make payments on property purchased by one of the spouses before marriage, the rule developed through decisions in California gives to the community a pro tanto community property interest in such property in the ratio that the payments on the purchase price with community funds bear to the payments made with separate funds.
Here is how the court apportioned the equity in its own words.
In the present situation, the loan was based on separate assets and was thus a separate property contribution. The down payment was also a separate property contribution. Therefore, under the Lucas-Offmuth formula, the proceeds of the loan must be treated as a separate property contribution. Accordingly, the formula would be applied as follows. The separate property percentage interest is determined by crediting the separate property with the down payment and the full amount of the loan less the amount by which the community property payments reduced the principal balance of the loan, $16,640.57 plus $40,000 minus $5,986.20 equals $50,654.37. This sum is divided by the purchase price for the separate property percentage share, $50,654.37 divided by $56,640.57 equals 89.43%. The separate property interest would be $109,901.16, which represents the amount of capital appreciation attributable to the separate funds, 89.43% of $103,359.43, added to the amount of equity paid by separate funds, $17,466.82. The community property share would be $16,911.29, which represents the amount of capital appreciation attributable to community funds, 10.57% of $103,359.43, added to the amount of equity paid by community funds, $5,986.20.
Many parties inquire about whether the interest and property tax portions of the mortgage payment affect the interests of the parties. The court was clear that the answer is no. We hope you found this presentation a good refresher.
Please visit our YouTube channel with approximately 25 short videos on family law topics. The name of our channel is Common Issues in CA Family Law. Bye for now.